BTC futures and options data show pro-trader sentiment was not impacted despite last week's 11.4% correction. In the past few months, Bitcoin traders had grown used to less volatility, but historically it's not uncommon for the cryptocurrency to see price swings of 10% in just 2 or 3 days. The recent 11.4% correction from $2,940 to $25,980 between August 15th and August 18th took many by surprise and led to the largest FTX collapse in November 2022. But the question remains, was this correction significant in terms of the market structure? Certain experts point to reduced liquidity as the reason for the recent spikes in volatility, but is this truly the case? BTC surged 70% plus in 2023, yet the Alameda Gap liquidity dip post-FTX and Alameda Research collapse remains. Supported by low volatility, read full analysis here. As indicated by the Kaiko data chart, the decline of 2% in the Bitcoin order book depth has mirrored the decrease in volatility. It's possible that market makers adjusted by their algorithms to align with the prevailing market conditions. And hence, delving into the derivatives market to assess the impact of the drop to $26,000 seems reasonable. This examination aims to determine whether whales and market makers have become a bearish or if they're demanding higher premiums for protected hedge positions. To begin, traders should identify similar instances in the recent past, and 2 events stand out. The first decline took place from March 8 to March 10, causing Bitcoin to plummet by 11.4% to $19,600, marking its lowest point in over 7 weeks. This correction followed the liquidation of Silvergate Bank, a crucial operational partner for multiple cryptocurrency firms. The subsequent significant movement occurred between April 19th and April 21, resulting in a 10.4% drop in Bitcoin's price. It revisited the $27,250 level for the first time, and it's more than 3 weeks after Gary Gensler, the chair of the U.S. Securities and Exchange Commission, addressed the House Financial Services Committee. Gensler's statements provided little reassurance that the agency's enforcement-driven regulatory efforts would cease. Bitcoin quarterly futures generally tend to trade with a slight premium when compared to spot markets. This reflects sellers' inclination to receive additional compensation in return for delaying the new settlement. Healthy markets usually display BTC futures contracts being traded with an annualized premium ranging from 5% to 10%. This situation, termed contango, is not unique to the cryptocurrency domain. Leading up to the crash on March 8th, Bitcoin's futures premium was at 3.5%, indicating a moderate level of comfort. However, when Bitcoin's price dipped below $20,000, there was an intensified sense of pessimism, causing the indicator to shift to a discount of 3.5%. This phenomenon, referred to as backwardation, is typical of bearish market conditions. Conversely, the correction on April 19th had minimal impact on Bitcoin's futures main metric, with the premium remaining around 3.5% as the BTC price revisited $27,250. This could imply that professional traders were either highly confident in the soundness of the market structure or were well prepared for the 10.4% correction. A comparison with the most recent event, the 11.4% BTC crash between August 15th and August 18th, reveals distinct dissimilarities from previous instances. The starting point for Bitcoin's futures and premium was higher, surpassing the 5% neutral threshold. Notice how rapidly the derivatives market absorbed the shock on August 18th. The BTC futures premium swiftly returned to a 6% neutral to bullish position. This suggests that the decline $26,000 did not significantly dampen the optimism of whales and market makers regarding the cryptocurrency. Traders should also analyze options markets to understand whether the recent correction has caused pro-traders to become more risk-averse. In short, if traders anticipate a Bitcoin price drop, the delta skew metric will rise above 7%, and phases of excitement tend to have a negative 7% skew.
and data indicate excessive demand for call buy BTC options ahead of the August 15th crash, with the indicator at minus 11%. This trend changed over the subsequent 5 days, though the metric remained within the neutral range and was unable to breach the 7% threshold. Ultimately, both Bitcoin options and futures metrics reveal no signs of professional traders adopting a bearish stance. While this doesn't necessarily guarantee a swift return of BTC to the guaranteed reduction. And that's the governor saying $29,000 support level